future. We're talking real money.
It's phone number recitation time on Talking Real Money. Hi, Don McDonald here, Tom over there. Our phone number, 855-935-TALK, 855-935-8255. Lots and lots of those telephone lines. You remember telephone lines? We still have them. You can call them with your phone. You still have one. Probably just one. Your family has multiples, but
I've got the one up above in the it's hidden away.
I had a form come up on something, and it said, home phone number, work phone number, cell phone number. And I'm going, they're all the same.
Same. I got the burner put away for other purposes,
but
it's still there.
The burner.
It's got, you gotta have
like you are so straight laced. What would you use a burner for?
We're doing a public radio show. You think I'm going to say that just right out here in front of everybody? Come on.
Okay, unless you've got some deep, dark life that I've never been aware of. I'm pretty sure that's BS. Hi again, Don McDonald, Tom Cock, Talking Real Money, 855-935-TALK, 855-935-8255. Tom loves to talk about, I don't as much, but Tom loves to talk about a thing called recency bias, which is where something that's been happening recently is what we expect to keep happening. And in the early part of, well, in fact, for most all of the 21st century, interest rates and stock prices moved in opposite directions. No, I take that back. Well, bond prices and stock prices moved in separate directions. Ooh, which does require a little lesson. A little lesson. Here we go. Little lesson time for
so
everybody.
Far, you're doing well, Professor. So keep it up.
Anyway, when interest rates rise, the price of bonds fall.
But tell us why.
Because higher rates on new bonds means those existing bonds out there with those lower rates have to lower their price to give the new buyers a comparable return to the new bonds. So bond prices and interest rates move in opposite directions. Therefore, generally speaking, for most of the 21st and the 20th century, most of the time, stock prices, when they would go up, bond prices would go down, but when stocks would go down, bond prices would bounce back a little bit, or at least not go down, and protect some of your purchasing power. That changed.
It did. And the thing, there's a couple of parts to that. You already know this, but interest rates generally declined from basically 1980 through 2019. I mean, they didn't go down every year, but it was kind of a general like then to where we got to basically nothing, and now we've come back up to 5% for what the Federal Reserve charges for overnight loans. I mean, so it's come up quickly. What the reason we're bringing this up is, and I do like James McIntosh's work. I don't think this is his best work.
No, but I do think it brings something. It brings something to think about for people who are investing, and recency bias is part of it. Predicting the future, though, I think is the bigger part of it.
And people make mistakes about that all the time. So, I mean, what he's pointing out here is, right, that we're in this weird spot where a stronger economy brings two conflicting things: higher profits for companies, which are good for share prices, and then, but the other part of that is inflation, right, which means that interest rates have to be elevated to keep inflation tamped down.
Which means older bonds are going to go down.
Right.
Yeah. But you see, that's taking us back to the normal thing, though. If stocks go up and bond prices go down, the problem is thrown into that, the wrench thrown into that is the fact that as rates are going up, people start worrying about future stock market profitability, not the current stuff. And this was the point I really wanted to get to with this. There is a tendency among investors to think that when the news is bad, recession. When the news is bad, recession, that's bad for stocks. But in an environment where people are worrying about corporate earnings in the future, if the economy does well, then they're betting that stock prices are going to go down. And so you're seeing all of these things happening that contradict each other. And that's what we want you to recognize. And then there's a lesson. 855-935-TALK is our number. Give us a call. We'll be right back.
Tom and Don are talking real money.
Do you suffer from hodgepodgeitis? I'm Don McDonald, and hodgepodgeitis is a disease of your investment portfolio whose symptoms include lots of stocks, loads of random loaded mutual funds, and maybe an annuity or two. Most who suffer from hodgepodgeitis dread opening their quarterly portfolio statements. They feel lost and confused. Investing seems overwhelming and the financial future uncertain. If you believe you suffer from hodgepodgeitis, see a 100% fiduciary investment advisor immediately. A proper diagnosis is the first step to creating a portfolio with a purpose based on a personal plan. Start on the road to recovery now by scheduling a free meeting with an Appella advisor at TalkingRealMoney.com. There is no cost, obligation, or high-pressure sales pitch. Take the first step at TalkingRealMoney.com or call 800-386-3004. Hodgepodgeitis is not a real disease, but treating it has been shown to improve mood, reduce fear, and even lead to a brighter financial future. Results may vary.
Your guides to a really great financial future. Tom and Don are talking real money.
I think the message that I'm trying to impart is that the markets sometimes seem logically sometimes are logically counterintuitive. The things when things are bad, markets are good. When things are good, markets are bad. And that's because you got all these people trying to look 10 or 20 or 30 or 50 or 1,000 steps ahead, complicating the calculation.
Yeah, and what happens is people turn into market timers.
Right.
People today telling me I'm moving money out of stocks into CDs because they're making 5%. People telling me today, well, the future doesn't look so great, so I want to own bonds instead of stocks. Here's what I think you should trust. Stocks and bonds are very different types of securities. Bond is an IOU. A stock is an investment in the company. You should own many of both. You should not worry about what happens to them today, tomorrow, or probably even a year or two from now. And at that point, you should reevaluate to see if I need to make a fundamental change based on my personal situation, or is my plan a good one? And that's about it, because the rest of it is a lot of hooey.
Well, and that leads me to the last paragraph, which I am going to read pretty much verbatim from this James McIntosh article in the Wall Street Journal. He says, those without a strong view on the direction of inflation, like your view matters, should expect their portfolios to be more volatile as bonds no longer cushion daily stock price moves. That hurts, adding unwanted risk, and so making leverage less attractive. Really?
Yeah, as it always should be. Yeah. Uh-huh.
But here we go. But for those simply buying a passive stock and bond portfolio for the long run, the best advice applies. Whatever correlations do, don't check except when you rebalance.
How long until Jason Zweig is back in town is my question.
This took how long to get to that sentence? In essence, John Bogle's quote, don't peek.
Stand up and don't do anything.
Don't do anything except when you rebalance. There, the whole article was wasted right up to there. This is why you don't have to do all this stuff. You don't have to tie yourself up in knots and this convoluted stuff you're trying to do. You don't need it. Stop it. 855-935-TALK is our phone number. Jason, welcome to the show.
Hey guys, the Tesla bull is back.
Oh, the Tesla bull!
Ah!
Oh, the bull is roaring.
I haven't followed. I got to check the stock price right away. So go.
It's kind of a mess. No, I didn't call to talk about Tesla today though. But so I had a couple questions. One about investing, just for like an individual retirement account, and then just wanted to ask your opinion about real estate. So first with the investing. So I was behind this year for my year-to-date retirement contribution. So I went ahead and just did kind of a mass catch-up. Basically, I basically spent all my I bought all the stocks to get myself up to my yearly limit. So I wanted to, one, get your opinion on if you think that's typically, I know dollar cost averaging is usually better, but I just wanted to kind of get it out of the way and not have to worry about it for the rest of 2023. So I wanted to get your take on that and if that's a material difference in doing it that way or not. And then
Well, okay, wait. I'm going to stop you. Hang on.
Actually, that's
Let's do the first question.
That's a good place to just pause.
Let's do the first question. Yeah. Okay. First of all, dollar cost averaging is not better.
No, it's not.
It's not better because the market has an upward bias. It's three out of 4 months. Basically, the market is up. I'm talking global stock portfolio. So in a general sense, putting all the money in, you should make more money because you're exposed to stocks for a longer period of time.
Okay.
Which is a good thing.
That makes sense. Okay, good. Well, so you're justifying my my decision. Great.
Yeah,
I like
exactly.
That.
We're actually
you
saying
were finally right,
you're
Jason.
right on
This
something
is good.
finally.
Well done, sir.
And the second question was about so obviously there's, and especially in the Puget Sound area, there's not been a lot of relief in home prices, maybe a slight amount, but and then interest rates are continuing to be high. So I guess I don't understand, with interest rates continuing to be so high or going so high, why have prices, I mean, I know it's a demand issue, supply issue, but why have prices just not come down more? Is it just purely lack of supply?
Well, I mean, yes, and
Yes.
because people don't want to sell their house because I got to turn around and take my 2.42% mortgage and turn it into 7%. Not going to do it. That's not going to happen.
A few years ago, I thought about selling mine. I'm never going to sell, ever. As long as I have a 2% mortgage and rates are 5 points higher, you have to pry this house on my cold, dead hands.
So what's the end game? What's the end game on this? I mean, interest rates may not come down for many years.
Build
many years.
more
So what is the end
homes.
game? Like,
Yep.
okay. Well, but that,
I mean,
but
they're
we've
not
been
building
saying
them very
that for a
fast.
decade. We've been saying that for a decade. It hasn't happened.
Okay, but there are some things here in the Puget. I don't know about the whole
Stop
entire
building
country.
so many people.
Well, no, there are some things here, though. They are making it easier, for example, to build ADUs on lots, so you can build more than one home in a particular location.
You mean granny
They're trying
flats?
to speed things up. They're trying to speed things up so you can build more homes, build smaller homes, which apparently they are doing in the Puget Sound region. So there are some things afoot. What do I think will happen? I think you're in the long term, you'll still see appreciation across the country of a little more than inflation. It's been weird here for a long time, so I wouldn't expect it to keep going straight up. That's my take. So,
Thanks, guys.
Yeah, good luck. Thanks. Just like all of us, the future's unknown. None of us can know that darn future. But it's a supply issue. I mean, in my town, where 2 years ago houses were, even a year and a half ago, they were selling like mad. Not
selling many. Yeah.
And now there is nothing. There is no inventory.
Well, you just had a hurricane blow everything down, so you can see why you wouldn't
part
have
of the
anything.
state.
But anyway. Okay.
Do you know how many hurricanes have gone over my house? Right over the top of it.
I've seen how many
Where I have
hurricanes in
walked
your house.
outside,
In your house.
Looked
That's a
up
different
in the eye
topic.
of the storm. We have had like 5 hurricanes go right over my house, and the thing is still standing. Pete, there is a misconception about hurricanes. People's houses, actual houses that are built of bricks or blocks,
yours has straps on it or something.
Well,
to the
yeah,
ground,
we have hurricane straps. But the thing that destroys most houses in hurricanes is a thing called
Pressure?
storm surge.
Oh, the water coming up.
You need to be close to the water to have that damage.
Like a little lake across the street from your house.
It is a hole in the ground that just happened to penetrate below the water table. But we are 100 feet above sea level, so for the ocean to top my property,
Take a heck of a surge.
the Gulf of Mexico would have to rise 120 feet above where it is today. They're not
so
even
you're very
predicting
safe.
that after Greenland melts.
Okay. Greenland's the one with all the ice. Iceland's the one with green. Got it. Okay. Couldn't always forget.
Yeah.
Okay. Fair enough. Enough on that topic. But
No,
real
I just
estate,
want to make it very clear that hurricanes
who
inland.
knows? So we're very strange time. I will say that, with high interest rates and low inventory. It's an unusual
Well, but it makes perfect sense. You have a 2% mortgage.
Yeah. Right.
I have a 2 and plus something mortgage.
Yeah. Yeah.
If I bought a new house, I would either do one of two things. I would either buy with cash, or I would stay here because I'm not going to get a 7% mortgage. It's paying too much interest. 855-935-TALK is our number. We'll be back.
Tom and Don are talking real money.
We
Northwest
got Richard
traffic
and then
every
Chris.
10
Am I
minutes
seeing that
on
right?
the 4s. from the High Performance Homes
Yes.
Traffic Center.
No.
Here's Sam
Bill.
Lundy.
No.
Thanks very much. We're continuing to see
Richard
growing
and
delays on
Chris.
I-5 southbound exit 186 to
Took a few to
128th
get there,
Street,
but I see
coming
it now.
through South Everett. That accident blocking the HOV lane. Things stop
Jason's
and go
not
from State
touting
Route
Tesla
526. We're seeing
because
delays of around
Tesla's
55
dropped
minutes there.
about 25%.
Everett to Seattle on southbound
Since he
I-5,
was
taking around
touting
85
it.
minutes.
Oh,
Seeing
yeah,
some
since
delays
July.
as well on northbound I-5. That
It's
same
gone
collision
from
at
290
US State Route
to
96,
as low as,
blocking the HOV lane
last
northbound
month,
as well. Delays of just
212.
under 10 minutes there. Seattle to Everett on
Almost a
northbound
third.
5,
Wow.
taking around 40 minutes currently. Our next northwest traffic at 134. I'm Sam
Tesla's a
Romney.
very volatile stock.
Send me the
And
car you
here's
like.
your forecast, sponsored
And
by
you still didn't
Northwest
send me the,
Cross Space
the
Services.
Throughout the
thing
afternoon,
for
we're
my-
going to find
my
most of
carrying
sunny
bag.
skies out there. Temperatures
Said you'd
low
send
to
me.
mid
Oh,
80s.
I
And
forgot
then
to
for
do
the next
that.
couple days,
Bag
cooler
light.
temperatures.
Yeah.
Mostly cloudy skies on Sunday and some showers popping up here and there. Same story for Monday, especially in the morning hours, but drier by the afternoon. Temperatures in this upper 60s to lower
Washington
70s.
7, Boise
both Sunday
State
and
6.
Monday. In the Common Center, there and on.
It's a close
And currently
one.
it's sunny and
Yes, sir.
76 degrees in Seattle.
For your real life and real future, Tom and Don are talking real money.
It's a show all about your dough. I'm Don. That's Tom. You're out there. We hope you call us. 855-935-TALK is our phone number, 855-935-8255. And Richard, it is now your turn. Welcome to Talking Real Money.
Hey guys, can you hear me all right?
We can. What's
All
up?
right, I'm driving in my car, and I'm retired 70-year-old, and I'm as widely diversified as I can be. And I just recently discovered certificates of deposit, like 1 or 2 years, that have a guaranteed 5% return, and that seemed marvelous to me, so I got some. And I just thought you might advise me, is that good to have a few of those? I could sacrifice the interest penalty if I ever had to, but it's better than having it in a money market account or in the bank, like you say.
Yeah, well, close. By the way,
close.
you say you discovered them. What did they fall into your lap? Were they waiting for you at home one
just
day?
looked
or-
and they were there.
I don't know. Oh, look at that.
the
There's a
door. Look,
certificate of
hey,
deposit.
it's a high
No,
interest.
Here's
I
the
just-
thing.
I
Okay.
just finally opened my eyes up and did the research
Okay.
on Bankrate and saw some pretty good returns because of the current rates.
Yes. Okay, but let's just look at the rates in a general sense. In a high yield savings account, you can get what today, Don? I mean, I forgot to look. 5%.
5%.
So you could still have access to the money tomorrow versus a 1-year CD that's paying 5. That's number one. Number two for me, because exactly what you said worries me. I just found this. It sounds to me like you just realized something's paying 5%, and that seems like a better deal than being in stocks. I would not trade exposure to stocks and bonds for CDs. If you have cash, if you want to hold a certain amount of cash, CDs can be a good place. But I wouldn't make a market timing move. I'll put it that way.
Yeah, no, this had been in, I think, Fidelity cash reserves.
Which is probably yielding close to 5.
No, it was in the one that was more like 1 or 2%, I think.
Okay, well, they have a money market fund where you can get more. But here's the thing. I want to make this about where the money should be about instead of where you're going to make more money. You should have a certain amount of money that's immediately accessible for whatever your current bills are. That's in your checking account. Shouldn't be much. Then you should have more money in a high yield savings account. That is for the next few months' needs. Whatever those needs might be, emergencies that might occur, so that it's accessible within a day or two, a couple of days. That's in a high yield savings where, by the way, you can get 4 to 5% without breaking a sweat. Then CDs are for longer term needs. Don't think of CDs as a place, well, I'll park it there and I'll take the interest penalty. No, then use the high yield savings for that. CDs should be where you plan to park the money for more than 6 months or a year or 18 months. And even laddering makes a lot of sense. And they also can be a bond alternative, but they have to be a bond alternative that is well managed with a disciplined laddering approach. So don't just buy things because they look good right now.
I bet I'll make you a bet now, because guess what once was very attractive, right? I-bonds. Nobody wants to buy those anymore because the interest rates have fallen. I bet you look back in 3 or 4 years, CDs. Remember when everybody's buying 5% CDs? They're only paying 3 now, so they're going to say, I'm not interested in those. That's my worry. When people look at something, it's shiny, it's new, it's paying a lot right now, I got to get into them. That's not a reason to buy anything, especially when you're moving something from equity exposure to cash type exposure. That's how I'd put it.
Make sense?
No, that's good advice, and I'll just leave you with the fact that I know people that bought CDs in, I believe, the 1980s at 15 and 16%, and he bought the longest term he could find, which might have been 3 years. I don't know, but it can work out. Thanks again.
It can work out, but it's a game you're going to lose sometimes and you're going to win sometimes, and so it's a lot of work and not that big a reward. Build the right portfolio to begin with.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
Hey there. Welcome back. We've got lines open for you again as some people dropped off, so give us a call at 855-935-8255. It's really free, and it's really easy, and we're really going to try and help you do things the right way. If we were going to do things the wrong way, we might succumb to the pressure from the crypto crazies out there to actually tell you that crypto is an investment. Oh, you know the word I left out of that sentence? Good investment. No, I just refuse to tell you it's even an investment.
But I do have some nice
not.
NFTs for you. Have you noticed those have completely fallen off the cliff? You don't even hear about those anymore.
Because they were nothing.
Tokens.
They were literally nothing. You could.
Yeah,
I mean, okay. Here is on my desk. This is a $5 bill.
Yes,
okay.
It is. I can affirm that. Yeah. There it is.
Sounds
That's
like a $5 bill, doesn't it?
It does. Yeah.
I can fungibleize this.
Then do it.
I can fungible this into all kinds of little $5 things, like one candy bar that 5 cents used to be able to buy. I can buy one of those. I can get one. If I have an NFT of a $5 bill,
yes,
I can't really turn it into anything unless there's another idiot who wants to buy my fake $5 bill.
Which is all fun and games. We're making jokes about this, but
it's not.
The fact of the matter
it's all a joke.
Actually, it's quite serious, because now the federal appeals court has told the SEC that they got to reconsider Grayscale Investments' application to launch the first Bitcoin ETF fund. Basically, they're telling them they said, I think, use the words arbitrary and capricious, which is never good in a legal standing.
Okay. So maybe they need to be a little more specific in their review.
It's going to happen, dude.
Of the application. They need to say in their review, we refuse to allow an exchange-traded fund that trades in nothing.
It's going to happen. There's going to be one coming. It's going to happen. They're going to make them do this. There's so much pressure. There was a piece about Fidelity not long ago about all the money they have put into being part of the crypto market when all this happens, and they want to make their money off this like everybody else.
Everybody wants to get a little slice of the fake action.
Exactly. Yep. So I'm just saying, it scares the you-know-what out of me, because I think people are going to get into this with no idea.
Of course they are, because it's an ETF.
Speculative. Yeah, right. That gives it a reason to believe in it.
And sure as shooting, a bunch of less than scrupulous advisors are going to tell their clients to put some money into these things. And the fact of the matter is, and we haven't done this for a long time. I think it's necessary to do it every now and again. And that is 10 minutes to explain the issues, because all of the, the bazingas of this world, and there are hundreds and hundreds of crypto news sites out there, and you're going to get 99.999% of your crypto news from a crypto news site. They have a bias toward crypto because they make money on crypto. But the reality is, when we talk about a crypto ETF, is it just going to be Bitcoin? Is that the winning crypto? Or is it going to be Ethereum and Dogecoin, which is totally made up? Nobody argues that anymore. Whatever happened to the, folks, Dogecoin was a joke, and you turned it into something with value? It was a joke. And now it's worth 6 cents a Doge.
Unregistered securities, completely. And yet they want to have an exchange-traded fund of them. It's an outrage, if you ask me. But as you said, everybody's looking to make a dollar on this. I can only say, if you're listening, please do not rush out and buy one of these when they come on the market. And I think it'll be sooner rather than later.
Well, I hope cooler, and some of the stuff I've read says that the SEC, I've read in the mainstream media, not in the Bitcoin media, has said that the SEC stands a very good chance of coming up with a response that will hold up in court. That they do have a very good case. It's just they're not presenting it as well as they should, that they can present it better. And then I hope that the SEC just takes it all the way to the Supremes. Because you can't hurry crypto. No, you just have to wait. 855-935-TALK. Give us a call. 855-935-8255. Because we're doing something that you need to be doing every once in a while, and that is talking real money.
Tom and Don are talking real money.
In medicine, a second opinion might save your life. With investing, a second opinion might save your future. The trick is getting one without a high-pressure sales pitch. Well, I'm Don McDonald, and if you've been listening to Talking Real Money, you know that our goal is to help everyone create a brighter future by investing and managing money better. That's why, in addition to helping everyone on our show and podcast, we are also committed to making our 100% fiduciary advisors at Appella available to help everyone make the best financial decisions based on science. So if you're being pitched a financial product or a system, make sure you get a second opinion with no cost, no obligation, and no annoying sales pitch by going to TalkingRealMoney.com or call 800-386-3004. That's 800-386-3004 or TalkingRealMoney.com.
Your guides to a really great financial future. Tom and Don are talking real money.
So, should you buy crypto? Give us a call. 855-935-TALK.
Oh, that's right. We have our Tesla guy. We need our crypto guy back. We used to have one a couple of years ago.
We used to have a crypto guy called all the time.
Yeah, we did. Yeah, all the time.
And that's where I got to tell you, they're the primary source. Crypto guys are a lot like some of the political people out there. I'm trying to think of a nice way to say it. And people was all I could do. Political people, in that they are so religiously fervent about their beliefs that they will attack anything that threatens their belief system. They are vicious.
They're responsible for a large part of global warming, I believe.
I think the hot air they spew. 855.
I'm saying. We lost the call, by the way.
Wasn't he just there?
Jerry was there.
I just saw him there. I just went, look, there was a Jerry.
I think you said something about people and he got mad, so that was that.
Okay. I guess he wasn't a people. But we do have a people who called in at 855-935-TALK and left a question. We get a few of those once in a while. Sometimes they're good, sometimes they're not. Well, the ones that where people call and leave a message, a lot of the times they're really just wacky, and I don't put them on. But this one is good, so I'm gonna. This one is actually a pretty good one.
Hi, Don and Tom. I have found amongst my father's investments an investment in a fund called the MSC Income Fund, and I'm not familiar with this. It doesn't work like any other funds I've heard about. It apparently is a debt fund where companies can come and borrow money.
Mm-hmm. Mm-hmm.
And I don't see a way to remove the funds that are in this, the money that's in this fund. They have a partial withdrawal offer going pretty often, but I don't see a way to completely remove the investment because I'd like to move it on somewhere else. What are your thoughts about this, and what would you do?
It's one of those, Tom.
Yeah,
one of those.
Started talking about a long time ago. Yeah.
Yeah, one of those private deals where they promise you a big return, which you may or may not get. They're lending money out to smaller companies who are higher risk, but they're non-liquid. They're a non-traded vehicle, making it very, very difficult to get out, except in small windows, and often for
quarterly.
And often for only a portion of the shares. So what you need to do is get, if this is part of an estate, then you need to get the death certificate, the assignment of this to whomever received these shares, and you need to get in touch with MSC. They're online. It's mscincomefund.com, and start the process of taking it out. You can even call. There's a phone number here for them. It's
well, you got okay now, but going back, you've got to make sure if these are inherited that the cost basis was increased to the time of the date of death of the previous owner.
Right, but these are income vehicles. The price barely changes.
It's up 10%. It said year to date.
Well, yeah, it's not big changes though. They've been all over the place.
10%'s not big to you?
Yeah, but overall, it's not that's not as big.
Overall, okay, you're right. But anyway, that would be one. Number two, always in these situations, I say, if you're just starting investing today, would this be a product that you used?
No. He wants to get out.
Okay, all right.
No, I mean
the question is how to do it. Is what you're saying.
Right. The problem is how to do it because they generally don't let you out all at once. Although in this case, they might. I don't know. This is something you're going to have to talk to them because they really do control.
In
the case of an estate,
they might say you can have your money back.
Yep,
okay.
maybe. And by the way, their promises weren't borne out by actual performance. Their 5-year average annual return. They were promising double digits, and their 5-year average annual return is 6%.
So, but if you take 5 years times 6, there's your double digits.
Annually, they were promising double digits.
Annually. Every year. Okay,
every year.
Yeah. 5 times 6.
Yeah. Okay. 1 year they've done 10. That's their dividend, Tom. By the way, that's their dividend, which is a taxable dividend.
But that's again, we talked about this recently, and that is if it's kind of confusing, it's hard to understand. You can't tell you exactly what they're doing. It's not something I think you should own, and I think you're making a good decision getting your money back. Absolutely.
In fact, here's a form I just found. Where you can fill this out and ask them to take the shares back. So get your ducks in a row on who owns what. I would just give them a call, and
it's not public. It's not publicly traded. Then this is private.
You got it. You've got to tender your shares back to them for a payment. Make sense?
Wow. Yeah, that does make total sense.
Yeah, there are a lot of these out there.
I'd get my money. Yeah.
Avoid anything that doesn't offer you liquidity in your portfolio because there's a reason they don't want to offer you liquidity. It's the fact that they're tied up in things that are illiquid too, and illiquid things can really come back to bite you in a big economic downturn. Companies like this, in a serious recession, can have all kinds of loans that default.
Well, they may be in trouble. They may be on trouble already if they're in commercial real estate.
Maybe, but this is all this is all loans, I believe. I don't think it's a real estate deal.
It's not okay. But I mean, you're right. That sector has been pretty beat up already. So, and REITs, I think, are about the only thing that are down so far year to date.
I got to tell you, if I found this in a family member's estate, I would be working really hard to get out of it. I would be on the phone with them. I would be filling out any forms they ask for, sending them in as often as I possibly can. And even if it's a slow process of liquidation, I would be after them every single quarter to do another one and another one and another one until it's all out of there. That's
okay. But you and I, for full disclosure, we're in a privately held company.
Can you get out?
I don't remember.
I don't think so. It's our own. We can't,
I don't think you can wake up tomorrow and say, "Give me all my money."
No, but that's a company we own a part of. We are a part.
Yeah.
We are actively involved in it. There's a reason.
That's true.
There was a reason they asked us to buy in. It's so that we have skin in the game.
Oh, that's it.
It's the old company wants you to have skin in the game. So, yes, full disclosure, we own a piece. We're partners in Appella Wealth.
Yeah.
Yes.
It's a good
not
company.
Not big ones.
No, we're really, really, really. There's not enough reallys to say how really small we are.
Really
We're
small.
Yeah.
Really small.
We're there.
We are. So we own a little bit.
We're more the public face, the ownership, not so much.
Yeah, no.
How about that?
No, we used to be when we were Vestery, but no, we aren't anymore.
It's okay.
But we're good with that. It was our decision, and it was a good one. It all worked out for the best. Look at us.
It did. Yeah.
Talking real money over and over and over again, 5 days a week. We're doing podcasts. We're doing live shows. We're trying to help you get this stuff straight. So pay attention.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
And since Tom snuck out early, if you want to bug him and make him help you out for free, he'll do it. You just have to go to talkingrealmoney.com and click on the Need an Advisor form and then fill it out. And down at the bottom, make the meeting date a Saturday and make the meeting time sometime before 11 a.m. Pacific time or 2 p.m. Eastern time. And then in the anything else box, type in big letters, Tom. There you go.
We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future, so past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures. Are we done now?